Welcome to the On the Rise podcast, where we talk about time freedom, passive investing through real estate, finance, and mindset. Let's dive in. Quick disclaimer as always, I am not a CPA, I am not an attorney or a financial advisor. This is not financial advice. I am not telling you or anyone else what to do. The views and opinions expressed in these podcasts are provided for education and informational purposes only and are not necessarily the views of my employer. All right, welcome back On the Rise listeners. Thank you again for jumping into yet another episode of the On the Rise podcast. I'm your host today, Jeremy Dyer. I've got another amazing guest, as I do always. I have the Tom St. John. Tom, welcome to the show.
Hey, thanks a lot for having me, Jeremy. It's a pleasure to be here.
Yeah, absolutely. And before we got started, Tom and I were kind of talking offline about our backgrounds. And I mentioned to him we're kind of brothers from another mother, really. And that is we have a very similar kind of background, what we're focused on today, et cetera. So really looking forward to this, conversation with Tom today. But Tom, before we kind of, dive into some additional questions here, my main one is, maybe for you just to let us know a little bit more about yourself, your journey, your background, what you're focused on today, et cetera.
Yep. Like you said, my name's Tom. I started real estate 2006. I kind of grinded my way up to the multifamily world. That was always my goal. And I'll dive in a little deeper on that. But I finally got into multifamily investing about 2015, and I just fell in love with it, every aspect of it. Around the COVID years, I made a big exit. I couldn't believe the prices I was getting for the properties. That the prices I got for them, I thought I wouldn't get maybe for 3 or 5 or 7 years. And so after that exit, I kind of transitioned a little bit towards the LP side and some income funds, some real estate debt funds, because I just found it very difficult to find the right deal that made sense. I just couldn't understand why people were paying what they were paying. And so fast forward to today, I'm kind of like we talked about earlier, I'm a fund manager, and I'm kind of the guy that vets the operators. I fly out to their locations, meet them in their office, have coffee with them, run the numbers, ask all the tough questions or the questions LPs might not know to ask. And I kind of help place money. And I only place money in the deals that I invest personally. And so I always tell people, what value do you bring? And I say, well, just invest where I invest, kind of plain and simple. But I started kind of same as you in 06, before the GFC. I'm kind of just clawing my way to one property at a time. 2008, 2009, I was able to, I think I had like 6 or 7 properties. But to me, I had like a thriving business at that time. I was like the king of the world. I had 7 houses. And, people talk about the GFC all the time about how the prices fell 50%. Well, I didn't care about that. That didn't bother me at all. But the problem was it was very difficult to acquire properties. There was a big credit crunch. And so from 2009 to 2015, I did all the craziest things in the world to acquire properties, crowdfunding like Prosper, Lending Club, a lot of hard money. And eventually 2015, I was able to buy my first multifamily property. And that's I always tell people it took me 9 years to get started.
Yeah, that makes sense. I would love to learn a little bit more about kind of, back to the very beginning. I got started in real estate really because, I wanted to scratch the entrepreneurial itch, right? And I wanted to diversify outside of Wall Street into Main Street, if that makes sense. And I just picked the right time to get in, right? Especially on the single family side during that global financial crisis side. But just kind of curious on your side, Tom, take us back to maybe the beginning. What sparked your interest to even get involved in real estate in the beginning when you were just getting started out?
Well, I've always had that. You mentioned the entrepreneurial spirit, and I've always had that. When I was like 18, 19 years old, I was importing marble from Pakistan and selling at craft shows and art fairs, like vases and little trinkets and animals and stuff. And then after September 11th, actually, it was very difficult to import stuff from Pakistan, if you can imagine that. But really, 2004, my dad retired. He worked 32 years in a power plant, breathing in coal dust and fly ash, and had a heart attack. I was forced to retire. And I always tell this story. I'll never forget. A couple weeks later, he got a telescope in the mail, like for a retirement gift from the company you work for. And to me, I just saw that telescope as like my future. Like that's what 32 years will get me, is a telescope. And so I kind of thought, I can't sell marble. I can't scale that. I gotta find a different way. And so really, I mean, it sounds kind of simple, but I just went to the library and just started reading every book on business, and they all seem to lean towards real estate at some point. And that's kind of how I got started.
Yeah, no, that makes sense. I appreciate that backdrop. Another thing in real estate that sometimes people get wrong is they think that, success in real estate, happens overnight, right? I think about, my wife and I buying homes, back in 2008 and 2009, and then being able to sell those homes just few years later with a huge profit, right? Or I think about those individuals that got involved in real estate investing, back in 2019 and 2020, and they participated in that kind of 18 to 24-month bull run, that commercial real estate really afforded, at a time in the market cycle where the cost of debt was super cheap. There was a lot of migration happening, immigration happening, and really rents were going up and to the right, and cap rates were going down and to the right and compressing. So I'd love to hear a little bit more about kind of maybe some of the biggest challenges that maybe you have faced over the years, building out your portfolio.
Yeah, sometimes I still think that can become rich overnight in real estate. Maybe that hasn't left me completely yet, but yeah, for anyone that thinks that, I mean, the story I tell about how it took me 9 years to even get my first multifamily was, I mean, if I had to start over again today, I don't even know if I would. I mean, the stuff that you have to go through. One of the biggest challenges I had about 4 years into my business, my brother was my first partner. He was kind of like the maintenance guy, real handy. I was kind of the deal maker, and he got killed in a car accident. It was a real tough day for me, but well, tough year. But like right away, I had to learn everything about the business, and so I spent the next 6 years as the leasing manager, the property manager, the maintenance guy. I was kind of I just did it all myself until I got into multifamily, and to the point where I had enough properties where I couldn't do it on my own, is before I finally asked for help. And once you ask for help, once you start to build a team, then you can really create a business. There's a difference between working in your business and on your business. And I don't know why it took me so long to learn that.
Yeah, it makes total sense. And it's obviously, hard to scale, a business when you're always only working in the business versus on the business. And, I even will challenge people sometimes to consider, if you want to replace yourself, that's great because that allows you to scale. But really that replacement, is really probably only going to be capable of doing it the way you can, about 60 to 80% of what your effectiveness is, right? But even though that's less than the way in which you can be effective, you're still allowed to scale even at 60 to 80%. So I appreciate that. Yeah, I would like to know, you've been kind of on the active side, of real estate, both on the single family, multifamily side. You've had, degrees of success, degrees of challenges, in the space. But, what really precipitated, you then making this transition into being now a fund manager where you're working, pretty much exclusively, it sounds like, with investors that want to deploy capital in real estate, but you're not the active owner operator. Instead, you're partnering up, with best in class operators to help place that capital.
Well, the LP life is the dream, right? You know, so I mean, ultimately, I saw myself in my later retirement years just investing in deals all the time. But what happened? You mentioned it with the COVID years, 18 to 22. I mean, you could throw a dart at a map of your county and make money on a deal. Well, that didn't really prove anything that guy could effectively operate and manage properties. He just benefited by the timing. So what I did, I knew the timing was right, and I made that big, large exit, and I very quickly jumped into the LP side, vetted the property, vetted the deal. I knew all the numbers. I never took a really good look at the operator. He had a bunch of other businesses going on I didn't know about, and I lost a huge chunk of money, rushing into the LP side because I didn't educate myself about it properly. And so that's when I started my firm now. So a few months after that, I thought, man, if that can happen to someone like me, I consider myself kind of an expert. If it can happen to anyone. And so I just spent like the next several years, traveling the country, meeting operators, understanding their systems, the teams they have in place. And I just kind of position myself now as just an expert in vetting operators because I took a big hit myself personally, not doing it the right way the first time.
Yeah, that makes total sense. And there's no such thing as a risk-free, investment. And so for the listeners that don't understand the acronym LP, that stands for limited partner. That you're basically the passive investor, right? There's the GP or the general partner. That's the main sponsor that's actually actively managing, the asset day to day. They acquired the deal, they manage the deal, they execute the business plan, and they ultimately, look to dispose of the asset. And then there's the LPs. Those are the passive investors that, maybe are looking to, get diversified into real estate, and they want to invest 50, or $100,000 into a deal. So now one thing that Tom and I have in tremendous common is we've done a lot of deals with a lot of different operators. We've evaluated a lot of different operators. And I always kind of talk about these three, main risk factors. And I would like to get your input on this as well, Tom. I'm trying to mitigate when it comes to investing my own personal money, as well as encourage investors to partner with us on these deals. I'm really trying to mitigate against operational risk, execution risk, and market risk. Okay. From an operations perspective, I want to align with a team that's vertically integrated, for example, from top to bottom. Maybe they focus on a very boring buy box, right? Of certain types of properties they look to buy. Number two is that execution risk, right? Have they done this before? Have they been successful in executing the said business plan? And then number three is market risk, right? Which none of us can control, but the operator can certainly help to mitigate any potential downside risks, as it relates to things like historic run-ups in interest rates, right? A glut of new supply, hitting the market, the impact of tariffs and inflation and all those kind of geopolitical, things that, occur, fairly regularly, and they have throughout our entire history.
And they always will. Yeah, I think maybe we are related somehow. But I look at, track record, just for one, the integrity of the people running the show. And I'm sure you do the same, but I look at operators, being paid by performance and not by fees. Now, there's always acquisition fees and stuff because it costs a lot of money to go through due diligence and to identify properties, of course. So I have no problem with an acquisition fee, but it's usually pretty easy to tell if an operator is going to get paid based on the performance, or if there is a fee-based firm. Being vertically integrated is huge. I have nothing against third-party management. I think it can work. Being vertically integrated, I think, is better. You talk about market risk and operational risk. What I do, and I'm sure you do the same, is I like to just stress test the property to the point of failure. I like to make it fail on paper because it's way easier to make it fail on paper than in real life, because that happened to me. So I'll take a rent assumption. And for your listeners, anytime you see an assumption, just trade that word for a guess. They're just guessing. So I'll do it $100 or 100 basis points, and the same with the interest rate. Now, I think debt is the biggest risk factor when it comes to an overall term of owning a property. So if they have fixed rate debt, that's great. But stress test that interest rate by 100 or 200 basis points and see how the investment performs then. So I like to stress test it to the point of failure, and then I'll ask the operators, have you considered this? Or we'll have a conversation from there.
I'm Zach Captainstall, CEO and co-founder of Rise 48 Equity. Our goal is to help you protect and grow your wealth by investing in the large multifamily apartment buildings. We do all the work as far as sourcing these large apartment buildings from the brokers, doing all of the on-site management with our vertically integrated property management company, doing all the renovations with our vertically integrated construction company. We completely rebrand the exteriors. We will renovate the interiors to our full platinum level scope, which increases the value of the asset to get that profit margin for the investors. If you'd like to learn about how you can partner with us on these exciting opportunities, and go to our website and set up a call with our team.
Yeah, and for the non-savvy investors out there, it's not that difficult to get the underwriting, for the deal. and make some adjustments in the underwriting to the projected exit cap rate or the organic rent growth assumptions, or the pro forma increases in rents. I mean, there's a number of different ways in which you can very easily in an underwriting model make a few tweaks to the numbers and really stress test what that kind of worst case scenario outcome would be for you as an investor. And so I really appreciate Tom, your insight. And I know that you've also really educated hundreds of investors, I think, at this point, as it relates to investing in alternatives. Why do you think more and more people are today looking beyond traditional stocks and bonds and wanting to deploy capital into alternative investments, mainly real estate?
Yeah, it's a great question. I'm not sure if it's very well known that you can invest in these alternative vehicles. Your whole life you're taught to save your money, invest in your company's 401k. And I know that seems old fashioned, but I still think that applies today. I didn't learn about all these alternative investing vehicles right away. And when you look at, it kind of occurred to me driving through my town, I saw this 330 unit apartment complex. And I just think, who in the world owns that? How can one person own that? And then reading and educating myself, you figure out one person doesn't own it. Like 100 different people, just like me, own a little piece of it. And so then that kind of opened up the door to me to educate myself on all these other vehicles. Like we talked about a little bit about real estate debt funds or income funds that are available to people that I'm not sure if they're completely aware of. And a financial advisor will never tell you about them.
Yeah, no, you're exactly right. And I agree with you. When I had that same epiphany, and now I never look at an apartment community the same again. And there's certainly other asset classes that you can invest into outside of commercial, multifamily. I personally have deployed capital in a dozen different, types of, commercial type real estate related assets, over the years. Looking ahead, Tom, kind of over the course of maybe the next, we'll call it, 3, 4, 5 years from now, commercial multifamily specifically as an asset class has really been, kind of beat up, I would say, over the course of the last 3 to 4 years, predicated because of, interest rates, like glut in supply, a number of other kind of geopolitical factors, which gives me a lot of optimism as an investor, that I'm kind of buying at the bottom of the market cycle. What's kind of what's your crystal ball tell you, where, commercial, real estate or commercial multifamily, is headed over the course of the next, call it 2, 3, 4 years?
I'm really bullish on it. I think right now is a great time to buy. And as you know, I mean, there's a lot of loan maturity going on right now. A lot of people that had 3 or 4% interest rates that are getting their 5-year term is up, and and people are they're selling because they have to and not because they want to. And so I think that opens the door for a lot of operators who are positioned well. Maybe not even market dependent on like 5% rent growth, but operationally, the operators who can create NOI, net operating income, and create value just based on really efficient operations. I think that the cream will rise to the top, so to speak, in these next 5 to 10 years. I think it's like the decade of operations is what I like to call it coming up.
Yeah, I know you're exactly right, and I definitely feel the exact same way. There's a lot of operators out there that we're currently buying deals from that weren't able to sustain operations because of the liquidity kind of crunch that they felt in the last few years. And this is certainly a time in the market cycle where it's a buyer's market. Okay, it is not a seller's market. Those that are selling right now in this current market environment are really forced to sell, right? As we know about real estate, it has a tendency, time has a tendency to heal all wounds. Things typically turn around relatively, quickly in the space today. And we're certainly seeing, signs of positive metrics, specifically in the markets that we typically, focus on. And so that gives us a lot of optimism. It's, when it comes to real estate investing, you can have the best operational team, you can, have the best ability to execute, a business plan, but you're still kind of, tethered in a way to where we're at in that market cycle and when it makes most sense, to sell a property to really maximize investor returns.
Yeah, that is key. I mean, people always ask me when the best time is to buy real estate, and I always tell them the sooner the better. Like the best time to plant a tree was 20 years ago. The second best time is today. That may not have been true like in 2022, but aside from that, operational excellence is key. And I'm not sure if anyone could have predicted, labor costs and the cost of materials going up like they did during that pandemic. That was kind of a curveball. I'm not sure anyone could have predicted. But yeah, I see a lot of opportunities in certain markets. Now, I'm based out of the Midwest, so I like a lot of areas in the Midwest. I may not make the front cover of Yahoo Finance or anything, but I like the the predictability and the fundamentals here. You don't get the cyclicality as you do like on coastal markets, although those are great markets too. But cap rates get compressed in those areas, and it's just a lot more competitive.
Yeah, makes total sense. And we saw a lot of that happening, in kind of the aftermath of COVID when you had a lot of in-migration, people relocating from cold weather climate states to, the Sun Belt high growth markets because they realized that they could do their job, in a sunshiny state that doesn't, go to negative 10 degrees, in the winter, that sort of thing. And we saw organic rent growth in some of the, Sun Belt markets of, 10%, plus. In some of those years, but we've also seen negative organic rent growth as well. So I like the Midwest. I live in the Midwest, and I call it the boring Midwest. And so I think the most important thing for investors to understand, is really the prudent approach is to diversify, right? And so your financial advisor is going to tell you the same thing when it comes to investing in Wall Street, right? Dollar cost average. Well, the same thing can be true, in real estate because you never really know where you're at in any given market cycle. And I use the example of back in 2016, 2017. I remember people were screaming a recession's coming, and a lot of people sat on the sidelines. Well, if you sat on the sidelines from 2016 to 2021, you missed out on a 5-year bull run, right? In real estate, right? Well, when everything was frothy and everybody was making money, back in 21 and 22, that's all of a sudden when the speculators came in and they emotionally invested and they got caught, right? When they thought they could make a fast buck and easy money. So I think the important thing is to understand is real estate is cyclical, just like any other, maybe stock or index fund, et cetera. And it's important or prudent for investors, to diversify along an investment timeline, as well as to even, consider diversifying into different markets as well.
Yeah, I think that also speaks to the point of how powerful the private alternative investing is. When you get a 7 or 8% growth year over year, it's way less volatile than the stock market, where you might get a 12 or a 16% year, but then you're going to get a 0%, a 4%. You're going to jump across the board. The guy that gets 7%, 8%, 10% every year over year, even if the other guy averages that, the guy that earned it every single year is going to be way farther ahead because he's capturing the power of compounded interest. You know?
Yeah, that's exactly right. There's, side of that is, within real estate, all my real estate investments, they're all growing tax free because of the power of depreciation, right?
Yeah, I didn't even talk about the tax advantages. That doesn't even count.
So a 10%, bump, in the S&P or in a stock portfolio is not the same thing as a 10% return, in real estate because of the tax advantage, that power of depreciation. So.
Yeah, I like I like that, and I've shifted a little bit to some income funds too, because again, to your point, they're not correlated to the stock market, and so in some of those investments only have like a 12-month lockup, but they're just income funds. You're going to earn a way better return than you would the market. Real estate's where you really get the growth, the equity multiples and the tax advantages. But I think for someone that's sitting on a nest egg, even diversifying within the private alternative space is important. Diversifying different types of products, different types of investments, and different markets, I think is important.
Yeah, absolutely. Well, this has been a tremendous conversation, Tom. Really appreciate the value that you brought our listening audience today. We'll include links in the show notes for the episode if individuals want to connect with you offline to learn more about what you're up to. So again, appreciate your time today and for providing us with value.
Yeah, I can't thank you enough for your time. It's been a pleasure.
Absolutely. And listening audience, thank you again for jumping into yet another episode of the On the Rise podcast. I look forward to having you join us on the next episode.
Thank you for hanging out with us today and for listening to the On the Rise podcast. This show is for entertainment purposes only. Nothing said on this show should be considered financial advice. Before making any financial decisions, please consult with a professional. This show is copyrighted by the On the Rise podcast. Written permissions must be granted before syndication or rebroadcasting.